All right. Good morning, everybody. It's 9 a.m. on Wednesday, September 20th, 2023. Happy Fed Day, everybody. FOMC meeting is in its second day. We're just a few hours away from Jerome Powell's press conference. There's never a dull moment at one of those. Well, I guess I should say the whole thing is pretty dull, but there's a lot riding on these dull press conferences. And so at 2:30 today, Jerome Powell will take the podium with his poker face and his scripted questions from all of the puppets of the mainstream financial press who will be asking Jerome exactly what he has told them to ask him, and he will be giving his scripted answers. Now, most of the market is expecting no decision today, no change, no spike in rates, 99% likelihood of no interest rate hike. There are a few brave souls out there who are saying they're still going to raise rates today. That's interesting when 99% of the market is saying they won't. So see how that one pans out. But the rate decision is not really going to move anything. All right. If he comes out and there is a pause, the market's not going to budge. It's about what Powell says today. What does the dot plot say? What does Powell say about the need for more rate hikes? Does he come out and does he smack the market around hawkish, saying, I told you I'm going to raise more. I told you, and you won't listen? Or is he going to come out dovish, sending markets higher? Remember, we're in this good news is bad news is good news mentality, where if Powell comes out and says, hey, the economy is too good, I need to hike rates more, the market's going to tank. If he comes out and he says the economy is lousy, maybe we can ease off, the stock market is going to take off. It shouldn't work that way, but it does. It sucks. This is the world we live in. We have to deal with it. But the big story this morning, guys, is something that my moderator Mish spotted. Refinances, applications to refinance a home spiked by 13% last week. Now, this is a weekly data point. We get this all the time, but such a big spike on a week like last week. This was for the week ended September 15th. Interest rates were up last week. The 10-year steadily higher all week long. Now, we've seen spikes like this in applications to refinance a home a couple of times this year, but those spikes always corresponded with big dips in the 10-year treasury yield, right? Lower interest rates, and so people took advantage of that brief reprieve and lower rates to refinance a home. But we didn't get that last week. Interest rates were up, and we got a 13% spike in applications to refinance. So why would somebody refinance a home? I mean, there's two reasons you would refinance a house: to lock in a lower payment. That's not happening, not with mortgages at 7.5%. Most people are refinancing mortgages at 2.5%, 3%. Now they're refining into 7%. What? Or the other reason to refinance a home is to cash out home equity, to increase that balance. You're signing up for a bigger payment, but you're getting your hands on that cash. And that's what I think is happening. And that is an alarming trend. People are using their homes as ATM machines. That is a phenomenon that we saw during the GFC or in the lead up to the GFC, as everybody borrowed against all this equity in their house. That was fake equity. It was driven by the speculative bubble in the housing market. And then, of course, when the value of the homes crashed, well, you still had all that expensive debt and you still owed interest on it and payments on it. And so it led to a financial crisis. And it looks like that's what's happening now, a 13% spike in applications to refinance a home. Now, that's just a spike in applications. Not everybody's getting it, and rejections are rising too. But this is a scramble for cash. And I did this whole live stream about it last Friday, about how the whole market is desperate for cash right now. Companies are borrowing, issuing corporate bonds at an alarming rate. Commercial real estate borrowers are desperate to refinance their loans, anything they can do to avoid having to pay back those loans for these buildings that aren't worth anything. You've got consumers are strapped with credit card debt at all-time highs, and now you've got people are trying to tap into their home equity to get their hands on cash because cash is becoming more scarce. The money supply is shrinking. The price of money is rising. That's interest rates. There's deflation on the horizon, guys. Even though inflation is currently rising, we're probably going to hear more about that. We're going to hear about the surge in oil prices today. Jerome Powell is going to talk about stubbornly high inflation expectations. But the real risk to this market is deflation. I've been saying that all year, and I still say it now, even though CPI is currently heading in the other direction. With that, let's shrink my big melon of a head. And while we're shrinking my melon of a head, won't you please hit that like button, guys? It really helps out the channel with the YouTube algorithm, and it helps get this message out to other people. Don't forget to subscribe if you're new here. I'd love to see you every morning. We do this. And don't forget, this afternoon, we will be going live at 2:25 p.m. Eastern Time, 5 minutes ahead of Jerome Powell. We'll be live streaming the whole press conference. We'll be counting Jerome Powell's mention of his tools. Get the JPOW tool counter going up again. And if something profound happens and markets move, you can watch it happen in real time. Now, right here, this is the CME Group's Fed Watch tool. This is the likelihood of an interest rate rise or no change in rates. What you're seeing here, this big blue bar at 99%, this is the likelihood that interest rates stay right where they are today, 99%. We've got just a measly 1% likelihood of a rate hike today. All right, so probably not going to get a raise today. But the important thing, what I'm more focused on, is the odds of a rate hike in November. Now, right now, the market is saying almost a 71% chance of no rate hike in November even. So the market's saying Powell is done here. I'm not so sure that. I talked about this a lot yesterday. I don't think Powell's done. I still think we get one more. I'm down here in the 28.9% camp. Okay, we'll throw in this little 0.3 of a 50% hike or 50-point hike. Basically 30% likelihood of another rate hike this year. I'm in the 30% camp. I think Powell is still going to raise one more time with CPI heading higher, with stubbornly high core non-housing services inflation, and the jobs market is getting a little looser, but not nearly enough, or at least not according to the metrics Powell has been citing. So I still think we get another raise in November. So we'll see if this one moves today based on what Powell says during his press conference. This is what's going to move markets. Does this 28.9% blue bar get bigger? If it does, market goes lower. Does this bar go lower? If it does, market goes higher. That is the big question going on today. Also, we've got the Fear Greed Index is still in neutral territory at 48. That's down just a tick from yesterday. The S&P is currently set to open up 11 points higher, about 0.25% pre-market. The Dow is up a decent amount pre-market right now, 127 points, 128 points higher, or 0.37% to the upside ahead of the opening bell. And the NASDAQ is looking pretty good, also up 36 points, or about 0.25% pre-open right now. Looking over at the commodities board, we've got gold futures are up about 45 cents. December gold futures trading at $1,954. December silver futures at $23.58. That's up about 13 cents or 0.5% this morning. We've got platinum and palladium are pretty much, well, platinum is negative, down about $2 for October platinum futures. Palladium's up 1.5%. Not a very big move in that one. Crude oil down 78 cents. Took a little bit of a dive yesterday. There was rumors swirling about additional draining of the SPR yesterday. There was a lot of talk about it in FinTwit. I have not been able to confirm any of those rumors. Somebody mentioned somewhere that they might drain the SPR more. Again, rumor only. I haven't been able to substantiate that, but it looked like it was enough to send oil lower. WTI crude at 89.70 for November futures. That's down 78 cents or about 0.86%. And take a look at the oil chart. I was telling you guys oil was due for a pullback here. It's just been too green for too long. We finally got a couple of down candles. We'll see where we close the day today. I'm looking at an entry point in the low 80s where I might go long some oil stocks here. I still haven't picked out what I'm going to do, but I wouldn't mind seeing oil pull back a little bit, maybe even retest this red line from a few months ago before moving higher. I do think the overall trend in oil is still to the upside because the Saudis have put a floor under that with their rate or their production cuts. The amount of oil that the Saudis and Russians have cut from production is basically the equivalent of all the dumping of the Strategic Petroleum Reserve from last year. And you can see that big dump in the Strategic Petroleum Reserve last year, that was enough to do this to oil prices. So if we get that in reverse, then we're talking about oil heading somewhere back around $120 a barrel. Plenty of room to the upside here, but I'm not rushing in right now. I'm not chasing at these prices. I think we'll get a better buying opportunity. The DXY is down about 18 basis points this morning, still over 105 at 105.02. That's down about 18 basis points. And bond yields are lower pretty much across the board this morning. The 30 years at 4.40. That's down about 2 basis points. The 10-year yielding 4.33. That's down almost 4 basis points, but still above that 4.30 line. 2-year Treasury yielding 5.058. That's down 5 basis points this morning, and the 1 month is unchanged at 5.39. Check out the U.S. 10-year Treasury, though, guys. Look for this one to move today, depending on what Powell says, but we are back above this prior high from back in October here where things started to break. We are well above the high from March where banks started failing, and now here we are up here over 4.3%, threatening to break out to the upside. Liquidity continues to vanish in the bond market, and now we've got borrowers are trying to refinance their houses into 7.5% mortgage rates. WTF are these people thinking? Here it is today in Trading Economics. The United States MBA Mortgage Refinance Index soared 13.2% to 415.4 this week, or that's for the week ended September 15th. It's the highest level in 6 weeks. Now, I'm more concerned here with the change here, right? Because, look, we've been higher than that this year, but when we were higher, it was when interest rates were a lot lower, right? We saw spikes like this going back over the last year or so, but every time we saw a big change like this, we had a dip in the 10-year Treasury during that week. We didn't have that last week. The 10-year Treasury went higher, and yet people are trying to refinance more. Why are people borrowing more into higher rates? Because they are desperate. That's why. That's the story here. And look at this, guys. This is a 30-year mortgage rate right now, 7.31%. The average 30-year mortgage rate, and that is for conforming loan balances, $726,000 or less. That rose by 4 basis points last week to 7.31%. Borrowing costs came back to 23-year highs in August. 23-year highs. And yet the demand is rising. When prices go up, demand is supposed to go down. People are desperate for cash. A year ago, rates were about a full percentage point lower at 6.25%. The average loan size on a purchase application was $416,800, the highest level in 6 weeks. People are borrowing at higher rates, and they're borrowing more. And why the spike in applications? I think it's got to do with this chart, guys. This is the M2 money supplier, M2SL. This is all the savings, checking, money markets, CDs. This is the supply of money. And right now it is doing something it has not done since the Great Depression. It's going down. We have a fiat money system, a debt-fueled economy. It is dependent on ever-increasing levels of debt and an ever-expanding supply of money in order to satisfy that demand for debt. But right now the supply of money is shrinking, even though the demand for debt is rising. All right, so shrinking supply, rising demand. What does that mean? Prices go up. And what is the price of debt? It is interest rates. And that's what we're seeing right now. Interest rates rising rapidly into a shrinking money supply and ever-increasing demand for debt. This is not a good mix, guys. And again, the M2 money supply, it has not contracted. It has not fallen since the Great Depression. 1930 was the last time this happened. I'd also mentioned this little bitty blip here at the end. Let me zoom in a little bit to just the last few months. This little blip here that started April, May, June, that I suspect is the Fed's spike in lending and some of the new liquidity programs that they rolled out in response to the banking crisis in March. I think that's a one-off, and we are about to see this chart start heading lower. We'll get another data point in a couple of days here. But also check this one out from the Kobayashi letter on Twitter this morning. This was a pretty profound tweet. According to Apollo, a new default cycle has already started, and default rates are skyrocketing. Also keep in mind, guys, when debt defaults, money is destroyed. So an increasing rate of defaults will expedite the rate of money supply contraction. Default rates on all U.S. corporate bonds have nearly tripled from their lows of less than 1% in 2021. So they're still kind of low, but they have tripled in less than 2 years. Since the Fed started raising rates, the default rate on all U.S. corporate bonds is up to 3%. On speculative grade bonds, default rates have gone from 1.5% to 5% in just over a year. The rate of change is important here, guys. That is a very rapid increase. Still not crisis levels of defaults. 5% is high, but it's not ridiculously high. But a move from 1.5% to 5% in a year, that is alarming. If the Fed can avoid a recession here, it would be incredible. History says a recession is due. And check out this chart here. This is going all the way back to the 1970s, all right? In blue is they're showing speculative grade. That's your higher risk bonds that are defaulting. And this is the rate of default. We're going from about 0% up to 16% on this chart. And then the green line, that is all bond defaults. So that includes the less risky debt. So you can see down here where we're at. You can see the blue rate is rising faster. That's your speculative, your higher risk debt. That's the one that fails first every time. That's gone from 1.5% to over 5% in less than a year. And the whole bond market is doing this, guys. We've gone from less than 1 to about 3% on all U.S. corporate bonds. So defaults are rising. Still pretty low rates, right? We're actually right around pre-pandemic levels. But you can see these big sudden spikes. Every time there's been some kind of a crisis or some kind of a recession, it's been preceded by these big spikes in the default rates, and that's already happening right now. And remember, when debt defaults, money is destroyed, and shrinking money supply is a big problem in this economy. Also, something to keep an eye on. This one came out late yesterday. The United States Red Book Index. This is a measure of same-store sales in the U.S. among retailers. This is a weekly snapshot. It measures retail sales last week versus the same week a year ago. The Red Book Index in the United States increased by 3.6% in the week ending September 16th over the same period a week ago. So that's right around the rate of inflation. So this number is not adjusted for inflation. Retail sales rising 3.6% tells me retail sales were basically flat, about the same number of stuff selling as a year ago. But the point I want to make is we've seen since mid-July, we have seen an increase here. We had a pretty good couple of weeks where the increase in retail sales was actually above the rate of inflation. It looks like that chart has topped off and is now starting to roll over. And we're now heading into October when student loan payments are coming back. It's about $400 a month for tens of millions of borrowers across the United States. That's going to hurt retail numbers. So I think we're probably looking at a couple of weeks in a row now of this chart starting to head lower. Again, consumers are strapped for cash. And it's not just American consumers or American companies that are hurting for cash. Don't forget what's going on in China, guys. That's still a thing. Country Garden leaves bondholders in the dark as interest is unpaid. You can restart that 30-day grace period on Country Garden. They are absolutely following the script of the Evergrande failure from back in 2021 and 2022. This is playing out the same way to a T. They miss a payment on a bond. They miss an interest rate or a coupon payment. It starts that 30-day grace period where they're not actually in default until 30 days go by. And then what they do is they run out that 30 days. They make the payment at the very end of that grace period, resetting the clock, rinse, repeat. This is what happened a few weeks ago. They made the payment with just a few hours left on the clock, starting things over. Now, yesterday, this is dated the 18th, 2 days ago, Country Garden missed another payment, thus restarting their 30-day clock. The note has a 30-day grace period before any possible default. The builder won approval to extend the last of a batch of 8 yuan bonds. Distressed Chinese developer Country Garden has passed an initial deadline to pay dollar bond interest. These are offshore debts again. These are dollars that they need, with holders yet to receive the money, keeping the threat of a first default looming. The builder, which has become a symbol of China's broader property debt crisis, had to pay $15.4 million in interest by Monday on the note. Two holders said they hadn't gotten payment as of 3 p.m. Hong Kong time Tuesday. Country Garden didn't comment, of course, and the 30-day grace period thus begins. And it's not just Country Garden making headlines. Chinese developer Sunac. This is one of the companies that was in trouble right around the same time the Evergrande default started in 2021. Sunac was right there with them. It's a smaller developer, but still a pretty big outfit. They have just filed for Chapter 15 protection in New York court. So Sunac is also bankrupt. They defaulted on their bonds long ago. Chapter 15 protection basically says, hey, American investors, you guys need to wait in line. We're going bankrupt, but we're going bankrupt in another country. We're going to pay back the people we owe money to in that country first. And if there's anything left, then we'll pay you back here in the States. That's the difference between, say, Chapter 15 and Chapter 11. Chinese developer Sunac has filed for Chapter 15 protection from creditors in U.S. bankruptcy court. The company sought protection under Chapter 15 of the code, which shields non-U.S. companies that are undergoing restructurings from creditors that hope to sue them or tie up assets in the U.S. Creditors of Sunac China Holdings approved a $9 billion offshore debt restructuring plan on Monday, marking the first approval of such debt overhaul by a major Chinese property developer. So the people Sunac owes money to are probably going to get pennies on the dollar if they are lucky. So again, debt defaults, money is destroyed, shrinking money supply, rising demand for cash, rising interest rates. This is all very deflationary, what we're seeing happening in markets. And guys, I have to say a thank you, by the way. Yesterday, I missed this one. You snuck it in there right at the end. Where is it? Let me find my images here. I have to say thank you to Kevin DeBella, who snuck this one in yesterday. He said, I think it's deflation that'll be transitory. Thank you, by the way, Kevin, for the super chat. Whether ZIRP and Burr or higher for longer, still $2 trillion deficits, $1 trillion interest on the debt. Burr equals inflation. So Kevin is saying he thinks the deflation will be transitory. There's I think a empirical data to support that, but it's not a given. And when he says ZIRP and Burr, he's talking about zero interest rate policy. ZIRP and Burr, of course, is money printing. ZIRP and Burr is the Fed's favorite tools to fight off economic collapse. And of course, when they ZIRP and Burr and they stave off economic collapse, they cause inflation. And then their tools are quantitative tightening and interest rate hikes to fight the inflation, which causes another economic collapse, which causes more ZIRP and Burr, rinse, repeat. The poor get poorer, they get richer. So, Kevin, there's probably a good case to be made for that. The thing is, eventually they won't be able to do that anymore. They have ZIRP and Burr their way out of the last 3 or 4 crises, going all the way back to the 1970s. I'm not so sure they can do that again this time. Maybe they can, maybe they can't. The last time they did ZIRP and Burr, they had to do so much that they caused the inflation that we're all currently suffering from right now. And the Fed lost a lot of credibility with a lot of people. And the only thing holding the U.S. dollar together right now is what's left of the Fed's credibility. If the Fed loses the rest of their credibility, if they ZIRP and Burr too soon, they lose the rest of their credibility, then the dollar is toast. And that's when the crack up boom starts. And people just start dumping their dollars for anything because they're afraid they're becoming worthless. So right now, the Fed can't just ZIRP and Burr yet. They have to let the deflation start. They have to let the pain get worse, because if they start printing too fast, people are going to say, oh my God, the dollar's done. Get rid of your dollars. So I don't think they're going to ZIRP. I don't think they're going to Burr as quickly as they have in the past. Now, they did do that in March. They shocked me how quickly they printed money in March. I know some people said what they did in March wasn't money printing. I think it was. We can argue the nuances elsewhere. But it's not so cut and dry that they definitely ZIRP and Burr. We're still at that fork in the road. They could go the route of the deflationary crash into great taking. Great book, by the way. Highly recommend it. Or they could go the way of ZIRP and Burr and hyperinflation. Nobody knows for sure which way they're going to go. Historically, they have gone the route of ZIRP and Burr. But they can only do that so many times. And if we're really at the end of this 50-year debt super cycle, then ZIRP and Burr won't work. They can't do it. They'll go the deflationary route. And if they do that, deflation won't be transitory. They'll probably try, Kevin. I'm not sure it's going to work. So thank you very much for the super chat. I'm sorry I missed that one yesterday before I signed off. And thank you, Steve Woitis, who says, can Americans get HELOCs, home equity line of credit? Yes, they can. That's one of the ways that they use their houses as ATM machines. I don't recommend it, although I don't really make recommendations here. I'm not allowed to do that. Basically, a revolving credit line on your house provided by a bank or other lender. Yep, that's one of the things that's going on. We're seeing a rise in HELOCs. I'm noticing an uptick in solicitations for HELOCs. I'm getting a lot of letters from banks saying, hey, you can lock in a certain line interest rate. I'm not doing that right now. I'm not looking to sign up for debt at these levels. Right now, I am hoarding cash. I think assets are going to get cheaper, and I want to be ready to buy those assets when that happens. And the problem is, if we do get a deflationary collapse, if the supply of money shrinks and the value of money rises very suddenly, your debt is still there, and you need to pay back your debt with suddenly more valuable cash. So be very careful. Also, during deflationary crashes, a lot of people lose their jobs. And if you've got HELOCs and you've got payments to make on a refi or a cash out refi, you are going to be hosed in that environment. Be careful using your houses as ATM machines, guys. Thank you very much, Steve. I appreciate the super chat, sir. And thank you very much. Dan Starr says, great show. Well, I appreciate that, Dan. Thank you for the support of the channel and the kind words. I appreciate that very much. All right, guys. I just want to say thank you so much for your time this morning. And remember, 2:25 p.m. Eastern time today, we've got the Fed. I'll be going live for J. Powell's press conference. Also, I want to say thank you to my Patreon supporters for everything you guys do for the channel. Link down below should you feel so inclined. Right beneath that link to the Stock Pulse Silver Symposium. We're just a week and a half away. I'm looking forward to meeting you guys in Vegas. Come on up and say hi. Let's get a drink, and let's talk finance and economics. I can't wait for Caesar's Palace and the Stock Pulse Silver Symposium just a few days away. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.